Hello and welcome once again to the Duke William online teaching platform for management accounting of the ICAG syllabus. Once again, we are still within the section C area of the variance reporting and stuff. Looking at the syllabus in the previous videos, we've looked at the behavioral aspects of standard costing and the impact of the different standards and all that on behavior. We've looked at productivity, efficiency, and capacity ratios. What we're going to be looking at now is operating statements. Okay, reconciling budgeted results with actual results using variances. So that is what we mean at. And then the causes of variances, which is effectively investigation of variances to understand what could be responsible for these things. Then in a separate video after this, I will be looking at this, and I've labeled that advanced variance analysis, which will come in. So I'm calling this basic variances. Then we can jump onto the advanced ones, and then that should be it. So a couple more videos, and then we're done with this section. All right. So as you can see, the basic variances, where I'll be reconciling budgeted profit to actual profits using variances and preparing operating statements, and then investigating variance analysis, looking at the causes of variances. All right. Now, what I will be doing in this session is use this question throughout all that I'll be doing. So it's important that I will encourage you to make sure you have your notebook already, and then you're okay to follow through. All right. So it says the following data is available on a company for a period. It said material. So the standard cost in the previous video, we saw what the standard cost is. It will take 5 kilograms, each costing 5 Ghana, making 25. 3 hours of labor time 10, making 30. I can see that. And then variable overhead absorbed on the basis of labor hours at 5, and then 6 for fixed production overhead. Full production cost, and we are told that the product sells for 100. So that it means that if the cost is 88, then it means that 12 Ghana is the standard profit on this one. Now, budgeted results. This is budgeted results. Production and sales were budgeted at 1,000 units. So don't forget, these are budgeted results. These are budgeted results. Okay. Now, then we look at the actual results at the end of the day. Production and sales, they produced and sold 1,200 units. Okay. And then total sales revenue amounting to this. So then out of this, we can find the selling price per unit. So the actual selling price, for example, will be 114,000 divided by 1,200, and that comes to 95 per unit. Then the materials bought and utilized comes to 31,900. Take note, they said they were purchased and used, meaning that all the 5,800 were purchased and used. I'll tell you what happens when we buy and we don't get to use all of it. Labor, 3,700 hours were used, costing 33,000, and oil paid for. And I'll tell you when we paid for, say, 3,700 hours, but then used less than, meaning idle time. Variable overheads incurred, actual and fixed overheads. Now, the question then says, prepare a statement for that period that reconciles budgeted profit of 12,000 with actual profit of 8,100, and you should show the variances in as much detail as possible given the data provided. Now, obviously, one may be asking, where did we get all this budgeted profit from? And needless to mention, as you can see, with the standard profit, so it means that budgeted profit will be 1,000 units budgeted at 12, and that gives us the 12,000. But then it says the actual profit was different. So then what was the actual profit? Now we can get the actual profit by taking 114. Okay, so just to confirm what we'll be doing later, material, so this is sales, material cost 31,900, labor cost 33,300, you knock that off, variable overheads 22,200, fixed overheads 18,500, and when we knock all of that out, that's what gives us the 8,100. So the whole idea here is we ought to have had 12,000, but then we got 8,100, and there's a huge difference between the budgeted profit and the actual profit. So what could be responsible for that? Is it cost differences or sales differences? So what we're going to do is to start with the cost differences, and as I go on, I'll be showing you how to write out the formulas where if you need to, but then it's important you understand where the formulas are coming from. Now, in the previous video, if you've watched that, you notice that the question we're asking when we're flexing the budgets were how much should it cost against how much it actually costs. So what we're going to see is we'll restate the actual. That's what we're asking. So the actual output has to be what? Restated in terms of the budget and compared to the cost incurred. So if I look at actual output, take note of this, 1,200 units. Now, every unit here, in terms of material, in total, ought to cost 25 per unit. So then, what that literally means is, if I'm looking at total direct material cost variance, once you get this principle, so it means that it should cost the 1,200, every unit ought to cost 25. Okay, every unit ought to cost 25 against a did cost, or call it actual costs. How much did that cost? And that is the questions I'll be asking there. So then if I look at this, the actual cost was 31,900, but then how much should it cost? And that is the question we are asking there. So this is 31,900, and the 25,000 ought to cost 30,000. So it means that we had 900 over the budget, and we say it is adverse as per what we had there. So this, don't forget, is the total. Okay, so the question is standard cost. Okay, the standard cost per unit times the actual production minus the actual cost, and that can be used as the relationship for the total direct cost. Now, interestingly, this is what you need to get. Now, we are talking 25, meaning that it did not cost 25, as you see. So was it because we used more than necessary, or we paid a price higher than lower, or lower than the 5? So if it did not cost 30,000 as it ought to be, then two things could be responsible. That maybe we utilize more kilograms than necessary, or we pay the price higher or lower than necessary. So we are going to do this in as much detail as possible. So yes, we're going to ask ourselves the same question. So I'm going to sub-analyze this into two. I'm going to look at the direct material usage variance, usage measured in kilograms. Okay, so then actually I could have called this the standard cost, and then so let's say this one gives me or a should cost or should use, okay, and did what? Use. So somebody will say this is the same as standard what? Quantity. This is important. I'm using different terminology depending on where you find them from. So means that if I take all the 1200 according to this standard, each unit should take 5 kilograms. So then it means that this times 5 kg should give me 6,000 kilograms. But then if you look at this, the actual, so I said you need to make sure you have this with you. The actual kilograms used there were 5,000, 800 kilograms. So then 5,800 kilograms is what was used. So then what we are talking about is actual quantity used. Okay, actual quantity used 5,200. Now that looks like good news. We ought to have used 6,000 kilograms for an output of 1,002, but we used 5,800. So that gives us 200 favorable. But don't forget, this is not in money, and we would wish to value this in terms of the monetary value. So then we will need to multiply this by the standard cost per kilogram. Now, so if you look at this, standard cost as per this is 5 per kilo. So straight away, this multiplied by 5 Ghana, and that should give us 1,000. So this time, it's now in money, and that is favorable. So it means that direct material usage. Now, usage is this. Okay. Now, it still doesn't explain this 1900 adverse. So then, could it be that we pay the price higher than this? So our next variance. Now, if you can follow what I'm just doing now, then we should be in position to do this. So what did I do? I took standard quantity, I took actual quantity, standard price per material. So then this variance is standard quantity, actual quantity, standard price. And this could be the formula for direct material usage variance. All right. Now, the next one I will be looking at is direct material, this time price, because I'm seeking to find an answer to why overall it is 1900. So price measured in money. So the question I will be asking myself is, how much should I be paying per kilogram? Now it is here, it says 5. Oh, then how much did I pay per kilogram? That is what I need to be asking. So then I come and say should pay, okay, or somebody will say, okay, instead of writing should pay, we say standard price per kilogram. What is it? We're going to pay 5. But then, how much did we pay? Okay, so this gives us a standard price, actual price paid. Apologies, yes. Actual price paid per kilogram. Now, how do we get that? I can get this by going to the actuals and saying, all right, if I paid 31,900 for a total of 5,800, how much did I pay for that? Very simple. How much did I pay? Then it's about 5.5. Okay, no problem. So this is what I have, 5.5. So meaning that the difference between every kilogram paid was small, and that is essentially adverse. Okay. So how many kilograms did I buy in all? So then I multiply this by actual quantity of or kilograms purchased. Okay. Now this is important. The reason why I'm insisting on purchased here is where we don't use up all that we buy, the quantities will differ. For the usage, I'll use the quantity actually used, and the material, the price, I'll use the quantity purchased, not the same quantity. So then I purchased 5,800 kilograms, actual quantity purchased. Okay. So then that comes to 2,900 adverse. So this time that is in money. So what did I do? So I have standard price, actual quantity. So then I can write a relationship for this. Very beautiful, very beautiful. Once you understand where the formulas are coming from, you don't need to chew them. And now, I can now explain that if my total was 1,900 adverse, I can now explain this by a usage of 1,000 favorable and a price of 2,900 adverse. It can be explained. If I add the two, they come to the total. It's important at this stage you understand these fundamentals, because that is exactly what we're going to be doing almost throughout these sessions. Very interesting. Okay, so that explains that. Now the trouble is with this particular formula, particularly for the price, is sometimes you might have a recurring number. And what I mean by a recurring number is, assuming I have, say, I spent 10,000 for 3,000. You're going to get 3.333, and sometimes you struggle to know at what point you cut them off. But then the other way around it is, if I take this, for example, I can expand this to be actual quantity, standard price, actual quantity, actual price. Now don't forget that this bit here is the actual cost. Okay, and the actual cost was 39,100. So what I'm going to ask myself is, I bought 5,800. This is actual quantity. I ought to have paid 5 Ghana each for it. So then 5,800 times 5 should give me 29,000. So this will be, it ought to cost 29,000, but then I pay 31,900, and so that is what explains why I paid 2,900 more than I ought to have paid. So I like the second approach, asking the same question for the actual quantity I purchased, which is the 5,800. How much should I have paid per kilogram, which is 5? So it means in all, I ought to have paid a total bill of 29,000. But then the actual quantity, actual price, which is the actual cost, was 31,900, meaning that 2,900 over the budget. I like the second approach to it. So just make sure you understand the dynamics, as in what you ought to be doing. This is very important. Now, what I would want to be doing at this stage is, rather than finishing and saying I'm going back to find what a typical operating statement is, And I'm going to show you in advance what a typical operating statement is. Now, for absorption costing for now, I'm going to show you. So, this Ghana cedis, this Ghana cedis. What I'm going to do is I'm going to insert these things into the operating statement as I'm going along. And I found the usage to be 1,000 favorable, the price to be 2,900. Now, don't worry, by the time we are finished, we have filled up this operating statement and we have been in the position to reconcile budgeted profit. So our budgeted profit was 1,000 times 12. We saw that there. So that comes here as 12,000. So it means that by the time I finish, I would have done with the operating statement. You'll find that in your resources anyway. But rather than finishing and coming back, I want to make sure that I deal with them as I move on. So that is it. So those are the positions of those workings that we have just done. Now the next thing is let me just do the labor total again, just the labor. After that, for the rest, I might not be doing the total. So if I talk about total direct labor variance, okay, total direct labor variance, this is what it is, okay, total direct labor variance. Okay, now the word total, again, just like we did for this, will mean that I will need to go and ask myself that in total, every unit, that is given the hours and the rate, should be, you notice that the total, I'm using the figures here on the right, so that is 30. So then the question I'm asking is, for the 1,200 units, how much should I be paying per for each of them? So yes, it means that here we are asking the question, we should pay, okay, or the standard is the 1,200 by 30. So that comes about 36,000. Yes, 36,000. But then we did pay how much the actual in total for labor cost. Oh, that's 33,300. Okay, so nothing to worry about there. So 33,300, and that sounds like good news. Good news, meaning that we paid less. And how much did we pay less? 2,700 favorable. Okay, so this is the actual cost. So again, I took the standard cost multiplied by actual production minus actual cost. So it's the same principle, standard cost multiplied by actual production and take away actual cost will give you total labor variance. All right. Now, again, from the total, what we ought to be doing is asking the question, okay, how do I explain this? All right. Now, looking at this, there are two things that could be responsible for the difference. Is it that the guys were slow, or now in previous video you saw we talked about our efficiency variances, and we saw that over 100% would mean that they were smarter or quicker, less than 100%. So was it due to efficiency, or was it due to we probably looking out for higher or lower rates of labor? So then, very beautiful scenario there. So direct labor, okay, let me do efficiency just like I did for the usage. Okay, so efficiency is measured in hours. All right, nothing to worry about there. So the same question should be, we should use how many hours. Now, if you look at this, each unit should take 3 hours. And then how many hours did we use in all? 3,700. So no problem. So the 1,200 units should take 3 hours each. That is the standard. So that should give us 36,000 hours there. So nothing to worry about there. Okay, so 36,000 hours, but then we did use how many hours? 3,700 hours. That is 1,000 over the budget. Oh, so that is adverse. Okay, so again, as I said, this is standard hours and this is actual or hours. Okay, so this is actual hours, nothing to worry about there. All right, now again, this is not in monetary terms, so we need to multiply this by standard rates per hour. So standard labor rates per hour. I look at it and it says we should be paying them 10 Ghana cedis every hour they work. All right. Now, so yes, the multiplied by 10 Ghana, and then that should give us I think, yeah, that's 1,000 adverse in Ghana. Yeah, I think I'm doing one more, so it should be 100 hours. My apologies there, 100 hours more. So that should give me 1,000 hours. So then, yes, the standard rate per hour. So what then is the formula for direct labor efficiency variance? It is standard hours, take away actual hours, multiplied by the standard rate. But this rate is the standard rate of labor. All right. Okay. Now, it still does not explain the 2,700 favorable. So then, again, I'm going to do direct labor rates variance. Okay, direct labor rate variance, again in monetary terms. So I'm going to do the standard rate that was given, that's the same here. So this standard rate is exactly what I'm bringing here. Then I work out actual rates. Okay, so if I go to the question, I can see if I did pay 33,300 for 3,700, then that is 9, isn't it? Okay, so that is 9. So that sounds like good news, meaning that we paid one Ghana cedis less. So that is favorable. But how many hours did we pay in all? So again, I will need to multiply this by actual hours paid for. Oh, actual hours paid for. Okay, we paid for 3,700 hours. So then this then gives us in monetary terms 3,700 favorable. So now that explains the 1,000 favor adverse and 3,000 that explains that. So yes, as you can see, we did standard rates, actual rates, actual hours. So this is standard rates, actual rates, actual hours. They're beautiful. So that is the formula for a direct labor rate variance. Now, as I did in the previous one, now again, we could expand this to be actual hours at the standard rates, actual rates or hours, actual hours. Again, this is actual cost like we did. So how much did I pay? I paid 31,900, I think so. Yes, that's what we paid. 33,000 divided by 3,700 there. So yes, so um, 33,300. But then for the hours of 3,700, we ought to have paid 10 Ghana each. Okay, so that should have been 37,000. Knock off 33,300, and that should give us the 3,700 favorable savings that we made. So it still brings you to the same point. Now, at this point, I want to look at two things. Now, it is possible, just like I mentioned, that the kilograms of raw material purchased will be not be the same quantity utilized in actual production. Same way, we may have paid 3,000, say, 700 hours, but then maybe out of that, 200 hours were idle time. So assuming I had, so what you do have here at the moment is I do have a total variance of 2,700 favorable, and that has been explained by a rate and efficiency, but so a rate of 3,000 favorable, efficiency of 1,000, adverse. Okay, so that explains that. Now I want to introduce the idea of idle time. Okay, so idle time essentially is time paid for no work done. So it could be breaks or something. So somebody is deemed to be paid 8 hours on a job, but then within that there's a 1 hour break, and so that has to be paid for or taken care of. Okay, now this is not part of it, but I'm introducing that now. Now, if I assume um, actual hours, worked, okay, amounted to say, they ought to have been using 3,600, and they used, so let's say 3,500 hours, then two things will change. Okay, now actual hours used. So then it means that rates variance, the rate variance of 3,700 favorable remains unchanged. Okay, so that variance will remain the same, but what changes is this time usage. Okay, now the usage is going to be standard hours, actual hours. The standard we said was the 1,200 ought to use free, which is free 600. Actual hours used this time is 3,500. So what we do have is 100 favorable. At the standard rate of 10, we now have 1,000 favorable on the usage as well. Okay, so 1,000 favorable. Now you notice that the two together will give me 4,700 favorable, and it still doesn't explain the total of this. So this is where idle time comes in. Now idle time is total time paid minus time used. So then we paid 3,700, we used 3,500 multiplied by the standard rate of 10. So yes, that gives us 200 hours multiplied by 10. Now at this point, the ideal time variance will be adverse because it's money paid for no work done. So that gives us 2000 adverse ideal time. Okay, 2000 adverse. So we can pretty much explain the situation here, but this time, okay, this time you have 2700 favorable, you have a rate of 3700 favorable, you have efficiency of 1000 favorable, and then you have idle time of 2000 adverse, and that works it out pretty well. So actually in this section here, in this one, we could then introduce idle time variance if we need to. So that is what you have here. So we had a rate of 3700 favorable, efficiency of 1000 adverse. So you notice that I'm putting adverse where they are, favorable where they are. Now I could have split that into the variance, but that is not the original, and the idle time, that is not the original thing. Now, just before I move on, I want to talk briefly about the interdependencies of variances. Now look at this carefully. Now this one has led to that, or which one? How do they connect, as in what is the relationship between the price and the usage variance? Now from here, I could explain this by saying that, oh, well, if we paid, the price is adverse, that it means that we paid for probably a better quality material, which was more expensive. But then when you have a better quality material, there's less of breakages or damages, or so efficiency of utilization is enhanced. And so that is what led to what the favorable, usage variance. That is interdependencies of variance. Now, assuming it was the other way around, and this was say adverse of 2.9, and this was favorable. Now, usage was favorable. One could even connect, or let's just leave it as it is. Let's just say the rate is favorable. Now, it is possible that it meant that we went for cheaper labor, and that cheaper labor can lead to adverse what usage. Okay, so if the usage were say adverse, as I was trying to say, one could connect the labor rate to say that probably inexperienced staff, they were cheaper, and so that meant that they wasted the material, and so usage was adverse. So the interdependencies and connections, you just need to examine them and see how that one can influence that, and how that one can influence. It can even go all the way down this. Now, even one could even look at this and say, oh, maybe if we happen to sell more, we are selling more because the material quality was good, so end product was good, and so sales were also up, and so on and so forth. So I want us to move on. Now that we have the basic principles in place, we can move on and look at the variable overheads variance. Very, very interesting. Now, the actual results is 22,200 here. Now, let's come back here. Very interesting. Now, I want to label this as the variable overhead absorption rate per unit. This is important. But then this 5 here is variable overhead absorption rate per hour. They are not the same. So the 5 is per hour and the 15 is per unit. Now, similarly, this is fixed overhead absorption rate per unit, because this is the unit cost. But then this 6 is fixed overhead absorption rate per every hour, because the hourly rate is 6, and so on and so forth. It is important to understand what rates you are applying, and so on and so forth. So because the variable overheads are and the other overheads are absorbed on the basis of direct labor hours, unless told otherwise. So you see they are all free, and so on and so forth, then it means that the efficiency variance for variable overhead will be the same difference we had as 100. Now, if you remember, we had the material, the efficiency to be 100. It's going to be the same, but what is going to be different is this time we're going to multiply this. So let me just steal this bit of it. Yes, and then demonstrate that here. Yes, I'm just going to steal that here just to save me some time of rewriting. So what I'm going to do here is I'm going to take variable overhead efficiency variance. So this is going to be the same as we had the 100 adverse, but this time I'm going to multiply it by the standard rate, and that standard rate, because this is in hours, will be variable overhead absorption rate per hour. Okay, so not the labor rate, but then the efficiency in terms of hours is the same. So variable overhead absorption rate per hour is 5. Okay, so 5, and so this then gives me a value of 500 adverse. Okay, so yes, same formula as you can see, standard hours, actual hours, standard rate. But don't forget, this standard rate is not labor rate, but then variable overhead absorption rate per hour. Very interesting. So I can actually go here and say that was 500 adverse. So I'm putting that here, 500 adverse, nothing to run. Now, the next one, which in line with the rates here, so sometimes they are called rates or expenditure. So don't worry when you see variable overhead rate variance or variable overhead expenditure variance. Never forget that. So they are interchangeable, either rate or expenditure. This is what it is. So let us look at the variable overhead rate variance. Now, in a similar vein, all that I'm going to do is for the 120, or the 3,700 hours, how much should I be paying? Now, literally, what I'm trying to do here is take notes here. What I'm trying to do here, I just want to jump on the the work I've done on the labor. So I'm going to have variable overhead rate or expenditure variance. Okay, and let me just see if I can make use of the quick way. I said actual hours standard rate. Sorry, actual hours standard rate, actual hours actual rate, and I said this is what actual cost. So nothing to worry about there. I can jump on that and say 3,700, but then my variable overhead absorption rate is 5. And how much did it cost me? I can see that there, based on the actual was 22,200. So beautiful. I put that there, 22,200, and that will give me the variance right away. So look at that. Phrase 700 multiplied by 5, that is 18,500. That is take away 22,200 and 22,000. Let me go again. 18,500 take away 22,200, and that is 3,700. So 3,700, which is adverse, because 18,500 is what we ought to have spent. Flexing the actual hours. So make sure you understand the flexible budgets we looked at in the previous video. So yes, 3,700, that is. So let's go and fix that in that bit. 3,700, which is the rate. Oh, no, adverse. My apologies. So 3,700. All right. So we are filling it by and large. We're nearly there. Once I finish, so the cost variances, I'm only left with the fixed overhead expenditure and the volume variance, which I can split later on. Then I come to the sales and we are good to go. All right. So before I look at the fixed overheads, I want you to appreciate something for me quickly. Um, you will notice that in our first video on absorption costing and the ABC, we said our overhead absorption rate um, equals total budgeted overhead divided by total budgeted um, level of activity. If you do remember this, we are in business. Now watch, if the total budgeted overhead is not equal to actual overhead incurred, and this one is also not equal to the actual level of activity or the volume of production, then we have what we call expenditure variance. And then this will lead to what we call volume variance. So the moment the budgeted overhead is not equal to actual overhead, then we have expenditure variance. And whenever budgeted level of activity is not equal to, or the volume or budgeted production in this case is not equal to this, then we have volume variance. This is what I want you to observe. For the first time, you can see budgeted here. For the first time, we are talking budgets. Now, the reason why I'm highlighting this is we are now in the section of fixed overhead variance. So this will be the first time we'll be making use of the budgets. This will be the very first time we're making use of the budgeted figure. So you notice that over here, this 1,000 has never been used. We've never used it. It's only been flexing up, call it flexing at 1,200, which is the actual production. So what are we going to be doing? Beautiful. Now, again, let me just start by looking at the total fixed overhead variance, the total. Okay, now look at it, so beautiful. Okay, so this is how it works, that overhead absorbed, the overhead absorbed will be, we know is the overhead absorption rate times the actual level of activity. So, okay, where is the overhead absorption rate? I can find that here per unit. It is 18. Fixed overhead absorption rate per unit, 18. So 18 times 1,200. Very, 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 very interesting. So yes, 18 by 1,200 gives me 21, 600. I hope that is it. Yeah, 21 600. Okay, but then overhead incurred, which is what the actual from the question, the incurred is 18,500. I can see that there. So 18,500. So it means that there is over absorption. Okay, some sort of over absorption of 3,100, meaning that we have taken more cost than necessary. So we got to reduce add back to our profit. So that gives us favorable. Okay, so that is favorable. Don't forget again, this is the total and that is that. So how do we explain this? Okay, the next thing is we're going to split this into expenditure and volume variance. So again, the fixed overhead expenditure variance. Very interesting. Now, if you follow what I've just done here, you have the answer. So what I'm doing, I'm going to compare budgeted overhead against actual overhead. So nothing strange. I'm going to take budgeted overhead, fixed overhead expenditure. Now, what is the budgeted? For the first time, I'm making use of the 1,000. And for each of them, it was meant to, I meant to have used what, 18 per unit. So interestingly, this is 18, so giving us 18,000 against actual expenditure. Okay, actual expenditure or actual overhead incurred, which is 18,500, and that is 500 adverse. Okay. All right. So I have this in money, 500 adverse. So can I just go back and fix that here? That expenditure is 500 adverse. So I come here and pick that in the 500 adverse. Now, what is the volume? I gave you a clue that the volume simply works with comparing budgeted volume to actual volume. So let's see, fixed overhead volume variance. So here I can say budgeted production, okay, against actual production. So let's look at that. Yes, budgeted comes to 1,000, actual comes to 1,200. So that sounds like good news. Okay, this is in units. Okay, so then I'm looking at 200 favorable, 200 units favorable. Okay, so I'll need to multiply this by the fixed overhead absorption rate per unit. And if it's per unit, don't forget that is 18, giving us 3,600, and that is favorable in money terms. So yes, 3,600 plus 500, or call it 3,600 favorable, take away 500 adverse, that gives me 3,100. Now, does it match this? Yes, it does match it. Very, 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 very interesting. So yes, but you see, this volume, in the previous video, measures of productivity, we said that production volume variance was a product of efficiency and capacity. So we're going to find out what could have been, or what could explain why we managed to produce 200 units more by splitting this into two further variances. So I'm going to try and explain that this 3,000 favorable, I'm going to find corresponding efficiency variance, corresponding capacity variance, and reconcile, so that what we learned in the previous video on measures of productivity comes into play here. What I'm trying to do for this program for you is to reorganize the topics in such a way that they will flow one to the other, so that the learning, the sequence can be, sometimes they're a bit strange in the recommended text. So it's important that experience comes to play so that I can put all together for you. So yes, efficiency. Don't forget we've done the efficiency. The efficiency we had is this same efficiency. So I'm going to still the same 100, but this time I'll not be using variable overhead absorption rate per hour, but then fixed overhead absorption rate per hour. So we are going to jump on that. This time we call this fixed overhead volume efficiency variance. Okay, so efficiency is measured in hours. We already have 100 adverts, and so all I'm doing is I'm going to multiply this by fixed overhead absorption rate per hour. And we saw that is 6 here. So nothing to worry about here. So 6, and that should give me a figure of 600 Ghana cedis. All right, 600 Ghana cedis. So that is that. Then the fixed overhead volume, this time capacity variance. I want you to pause here and pay attention to what I'm going to do here. Now with capacity, we are not comparing like with like. What we are asking is how many hours were available to work, how many hours did we actually work, just like working out that ratio. And then so I'm taking hours and I'm saying budgeted hours. Okay, now budgeted hours is based on budgeted figure. My budget was this. Each ought to have taken 3 hours, and that gives us 3,000 hours. But then actual hours worked comes to 3,700. Now pause here. Now it sounds like we have used more than we need. Now here we are not comparing like with like. The simple reason is this one relates to 1,200 units of output, whereas this relates to 1,000. So it is not like for like. Now the bottom line is this. Think about it. Capacity. Let's say we had capacity, or let me put it in a layman's language. We thought the guys had energy to stand on their feet for 3,000 hours, but they surprised us by being able to be available for 3,700. So it is good news. And in fact, that is what explains why we were able to produce 200 units more. Because efficiency, they were slower, but then because we gave them possibly more hours, or it could be overtime or something, they managed to do more. So it is deceptive to look at this and think this is adverse. No, it's when actual. So anytime actual hours is more than budgeted, capacity is favorable. Please take note. Anytime actual hours is more than budgeted hours, capacity is favorable. Now again, at this same rate of 6, that gives us 4,200 favorable. So yes, we can now explain the 3,600 volume. So a volume variance of 3,600 favorable can now be explained as a efficiency of 600 adverse and capacity of 4,200 favorable. Very, very, very beautiful, and that should do it, and that naturally explains that. So if we come back here, our volume was 3,600 favorable. So let me quietly put that there, 3,006. So at this point, I have finished with all the cost variances. So what I need to do now is to try and work out my sales variances. So I'll deal with sales volume variance and the sales price variance. I want to do the price variance first, price variance. Now the question is the same. There's a standard selling price of 100 per unit. Okay, how many how much did I sell each? We saw that here that I could not sell it for 100. Okay, so I'm looking at the sales variances now. Very interesting. So we are not going to do anything different. So sales price variance. Now, when you have understood these basic variances, then you can understand advanced variances, which will be the next video that follows from here. It is important to get this. Make sure your foundation is solid, and then we can move on to look at the rest of it. Okay, so somebody will say, what is the budgeted selling price? So budgeted selling price per unit was 100. Actual selling price per unit. Don't forget we sold 114 for 1200 units, and so that was 95. Is that good news? No. Why? Because we set out to generate a revenue of 100 each, 100 Ghana each, and now we have 95. So this effectively is 5 adverse. So then actual sales quantity of 1,200 gives us 6,000 adverse in monetary terms. So one again could have done the same thing, that, oh wow, we sold 1,200, this is the actual quantity, we ought to have sold it at a selling price of 100 each. Okay, don't forget that would have given us 120,000, but then actual sales revenue came to 114, and that falls short by 6,000, and so that explains that. Beautiful, that falls short by 6,000. So what do we do? I'm going back to let's put that there. So yes, let me just do the sales price variance. Yeah, let me just do a 6,000 adverse. My mind, yeah, that's that. All right, nothing to worry about there. So if we did not sell to generate 120,000 as we ought, then it means that either we sold more or less as well. So volume differences. And yes, indeed, the volume differences were evident there. We ought to have sold 1,000, but we ended up selling, 1,200. So sales volume variance, very, very important. Now, this is where you need to pause again. It will depend on whether the organization is applying absorption costing principles or call it marginal costing principles. But then the bottom line is we go to the basics and say, okay, budgeted sales. What is budgeted sales? 1,000 units. Okay, how much did we sell? Actual sales 1,200 units. That sounds like good news, favorable. Good news. To sell more is always what a good thing. Now, okay, so if we're going to sell more, how then do we value this? So we multiply this by the standard margin per unit. What is this standard margin? It is standard profit margin, okay, where we are using absorption costing principles, and then standard contribution margin, because in marginal costing principles we've got to demonstrate contribution. So marginal costing principles. Now, right from the outset, we worked out that the standard profit margin was coming to 12. Okay. All right. Now, so that is 12. Nothing to worry about there. Okay. So It means that if I multiply this by 12, that will give me. So if I'm doing absorption costing principles, presenting the pro forma in that, then it's going to be 200 times 12, and that is 2,400 favorable. So as you can see here, I'm using this one, so 2,400 favorable is what I'm going in for. So yes, that is that. Okay, so you can actually see this is 14,000, 14, and it said that's the standard profit on actual sales. Actual sales was this, the standard profit was 12. So yes, that confirms that you can have that there. Okay, now this is what I have now. Now I'm going to finish off this and then come back to that. So I have 14,400. Knock out 6,000, and that is 8,400. Now you don't attach any sign to it. So what you then do is you're going to find the total favorables, total adverse, and then you put them there against that. So let's do that. Total favorable. So this comes to I add up all that. All the favorables comes to 8,300, and this comes to 8,600. Now don't forget this is favorable, this is adverse. So means that gives me, I need to step this down. Okay, nothing to worry about there. So actual profit. So then that naturally gives me 300 adverse. And you see, when I do have the 300 adverse, then against the 8,400, that is what brings me to the 8,100. Isn't that beautiful? Which is the actual profit. So yes, I have been able to reconcile in as much detail budgeted profit to actual profit. Now here I'm using the absorption costing principles. Now we could be asked to use the marginal costing principles. What then changes? We will start with budgeted contribution, but before we go to that, there is something I want to draw your attention to quickly. Now, what is contribution? Contribution essentially sales minus variable cost. So in our case, if you look at this, the selling price is 100, and the variable cost will be all cost from here. So 30 plus 25 plus 15 will be 70, and that is contribution per unit comes to 30. Very, very interesting. Or another way, I need you to get this particular thing, is another way to do that is if I know the profit and add on the fixed cost per unit, I can also get that the profit was 12, the fixed cost per unit was 18, and that should also give me the contribution per unit. Now, the interesting thing I want you to see here is, as you can see, I've actually done, all these ones for you, and I want to now demonstrate how this differs from, the marginal costing. So look at this. Now, in marginal costing, all cost variances stays the same. So essentially, variable cost, fixed expenditure, but the volume disappears. So you see that in the fixed overhead expenditure, we had the volume. The volume now disappears, and now we have just the expenditure. I'll show you where the volume will go. It disappears because we do not link fixed cost to what cost per unit. And then the sales volume variance is now a standard contribution margin, that which I just explained. So look at this, you'll see that we will start with budgeted contribution. So in our case, for example, our budget was 1,000. Contribution of 30 will give us 30,000. Then the sales volume variance, don't forget the volume was 200 favorable, and the contribution is 30. So that gives us 6,000 favorable. The price was 6,000 adverse. So that brings us to the same 30,000 as you can see there. So watch, I've done that just to save us some time. You can study that. So this remains the same, that remains the same, that remains the same. But then total variable cost, and we know variable cost out of sales, okay, gives us contribution. So this is effectively the actual contribution, and you can actually check it that we had sales of 114,000, materials 39 base, labor 33,300, variable overhead 22,200, and that should give you about that, I think. Yeah, actual contribution. Now that we have the actual contribution, the budgeted fixed production overhead, we needed to just bring that down, and watch is always under the adverse because that is an expenditure, and our budget was 1,000, and the fixed overhead absorption rate per unit is that gives us 18,000. Then the overhead expenditure variance. So you see that the volume variance, as we said, disappears. So these two then gives us that. And when we have added that to the actual contribution, we are back to the actual profit. So interestingly, you can try that there. So interesting, we are almost done. We should be done in the next couple of minutes. Now, at this point, we are interested in investigating variances, that what could be responsible for why we had an adverse variance and blah, 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 and so on and so forth. So it's important that you discuss these ones in the context of the scenario where possible. Don't just chew them by heart. Now, material price variances could be either adverse or favorable. So if we pay a higher price, for example, we're going to get adverse. Lower price, favorable. If we lose discounts, it's going to be adverse. If we gain quantity discounts, it's going to be favorable. If we buy in lower quality, chances are that it will be favorable. Lower or higher quality than plan. Substituting material due to unavailability of plan can affect both variances. So where we have to change that, it means that variances could either be favorable or adverse as well. Now the usage. Why would the usage be favorable or adverse? Greater yield from material than planned will give us favorable usage. Okay, good quality one. And then lower yield will give us adverse. Gains due to substitute of higher quality, as I said, greater or lower rate of staff as well. And then I can actually add one here which just comes into memory. The staff or labor, experience can do that. When they are cheaper labor should lead to adverse usage. Experience, which are likely to be paid more, will be given that as well. So yes, labor rates, higher rates being paid than planned will lead to adverse. Lower grade of labor or higher grade will mean we'll pay more, so that is adverse. Lower grade, we are likely to pay less, and so favorable payment of unplanned overtime, making the total, because this is based on actual hours paid, not used, and then unplanned overtime or bonus leading to adverse as well. So efficiency, incorrect grade of labor. So poor substitute or cheap labor, efficiency can be more, and so poor grade, for example, will lead to adverse, and so on and so forth. Poor workshop organization of provision, incorrect materials can affect the efficiency as well. It means that they will take more time to work on it if the material is poor. So these are things you need to look into within the scenario to be able to talk about that. So idle time, as I said, will come as a result of machine breakdown or illnesses. Now, idle time, the norm is to expect idle time to be adverse because it's money is paid for no work done. But the bottom line is idle time can be favorable. The reason is when we have a planned idle time. So let's say our planned idle time is 300 hours. Then actual idle time is 200 hours. So despite this, we'll have 100 favorable. So idle time can be favorable if we, sort of use less than we budgeted. So yes, the overhead expenditures as well, causes of variance, the same. Variances can occur, inefficient operations, measurement errors, out of date standard. So maybe the standard we have has not been updated for a long time. So then we are measuring against something which is a bit out of place, not very realistic. And so, that can lead to what? Huge adverse variances, for example. Random fluctuations in prices as well. Now, still on investigation of variances, is it worth investigating? Now, there is what we call, this is what I just talked about, interdependencies of variances. There's what we call management by exception. Now, so we could have some tolerance level that if prices go up by 5%, we would investigate, because don't forget the investigation takes time and money, so that once it's up by more than 5%, but if it goes down by 1%, it's just within tolerable limits, and so we wouldn't need to investigate. And that is by the materiality of the difference between that. So we do management by what? Exception. So we only look for the huge differences and see, is it the standard that needs to be modified, or we need to look at our what practices. So again, we'll look at the trend. Are we having regular adverse variances, sustained adverse? That means that we need to look at something and see whether the original budget needs to be amended as well. So here again, the cost versus the benefits of this is put in use. And then what type of standard are we using? Is it an ideal standard? Is it an attainable standard? Or what is it? Because all these ones, as I said, can influence human behavior and the type of this. And then the next thing is the change in, say, material price. Was it due to a factor beyond the control of management? If so, then we are not doing planning operational variances here, but then we will need to separate the variance into how much can be controlled by the user and how much cannot be controlled, so that it can be fair. Okay, so we need to assess controllability in order to have this fair. So yes, that brings us to the end of this session, and I look forward to seeing you in the next video.